I'll just go over what a prop firm is really quickly. So basically futures, it's just leverage common stocks. Basically, if it moves, like your stock moves up $1, it's basically move up, okay, 20 when you're on the NASDAQ. So it's like playing options, but you just don't get all that volatility and all that decay. And then the prop firms like Top Step, but they gotta mute you. Basically, a prop firm just basically lets you bypass that day trading rule, $25,000, and they just give you a simulation account. You just trade. So your risk is drastically drops. You're paying about $50 and $150 to activate a funded account, and whatever money you make on that you get to keep. So it drastically reduces your loss. So I would recommend starting with Top Step, just paying the $50 a month here. Really cheap to what they're giving you. They're giving you basically a graph, a chart, data, as well as an actual account that you can play with, and it resets every month with the $50 renewal. So you just go to the Top Step, make an account, you hit select, and you just go through the process here. Choose Top Step X because then that's their platform. Go next, go through this, pay it. Once you've paid it, you just use your same exact login. You just go to topstepx.com, just log in, and that's all it is. They basically built their own platform off of TradingView, so it acts very much the same. You can place your orders directly on here as well. One thing that they offer that's pretty popular compared to just having TradingView is the tilt. The tilt basically gives you an idea of where the market's currently at. Like, are people mostly going short or are they going long? That's basically it. That's what I'd recommend starting with. They even give you a practice account, so you can actually use the practice account and play with that. And you just reset it each day, and it's completely free. So for $50 a month, is you get a pretty big package. I wouldn't recommend buying the Trading View itself. Like this, it's very similar, but you don't get an account or anything like that. You just get access to all the charts and the thing. So I'd recommend getting started just the $50 a month, just so you get an idea of what futures is, and then play around with that. I don't recommend buying any new accounts. I'd recommend if you were to fail your account, let it reset at the end of the month, and then just play on the practice account each day. I mean, expect to fail in your first month. So let's go into basically the three things we need to know to be successful here. So one is we need to identify the peaks, as in charting. You need to know how to chart. And we're going to use the peak strategy. Um, it's just a lot easier to read. I should be able to flip you a chart, and you should be able to tell me exactly is it's the direction up or is the direction down. We don't need to be sitting in front of a screen. You don't need to be drawing lines, support lines, or anything like that. Okay. You should be able to chart without any indicators. You should be able to chart without any kind of assistance. You should be able to look at the graph and know where it's going. And that's the goal with this. So we're going to go through that. By the end of this, you should be able to do that. Two is identifying your entry. So you need to know when to enter, when to exit, and when to take profit. And then three is probably the most important here, is your risk management. You should be able to play number three, even if you have no idea what number one and two is. you should still have a pretty good chance of winning with just 3. So even if your 1 is really good and your 2 is really good, if you have bad risk management, you're going to end up losing. It's about your success is based on probably about 5% of 1, 5% of 2, and then about 90% of 3. So let's do peaks. Peaks is only ever 3. It's 1 peak, 2 peak, or 3 peaks. And each peak means something different. Peak 1 or P1 means direction. If you can identify P1, you know what direction the graph is going. If you've identified P2, you have identified momentum in that direction. Momentum meaning breakout. P3, if P3 forms, it's consolidation sideways. Okay, so we'll do an example of what P1 looks like. P1 is just that. There is no P2, it's just here, P1. Direction, it's up. Really simple. A lot of times when you're in a P1, you don't know what to do because there is nothing to do. The only time you can actually do something confidently is when there's a P2. This becomes P2. When this happens, there's very strong momentum to push up like this. If it fails, if it bounces here and fails, it'll fail here. And that what that forms is a P3. If it hits this point, when P2 forms and it bounces and it gets stopped, it becomes P3 and it goes like this. So this is what we'll usually see. So you identify P1, that's P1. This is P2. So these patterns are going to be really easy to recognize really quickly. And this is P3. Okay, P1, P2, P3. And then you just flip them for going down, but we're just going to focus on going up. I'd recommend not playing short your first time. I would just recommend just looking for opportunities to buy long. And once you do it enough, you will recognize it going down. So you recognize the opportunity to short. So I mean, we can take an example here. Look at this. What is this? It's just P1. But what if it didn't form yet, right? What happens if it did not form? Oh, I can change this. So we were to zoom in. What does that look like? This would be like that. This pullback become P2. Then here's the indication that pulls up. This would be a very good entry point, right? We'll talk about entry points later. But you can identify that this is P1 in P2. What's this pullback? How do you know how much of a pullback before P2 is established? You know by drawing a ladder. I call this a ladder, even though it's called the fib. I don't like calling the fib because I don't believe in the fib. The moment a P2 is formed is when a pullback hits the 50% line. And that's usually when you can place your entry if you'd like. But going back to 50% line, we can see here this bounce. Let me pull that. This bounce here indicates that it's gathered enough momentum that it can break this high peak here. And so you can actually look at this and see if it were to pull back 50% of that. So we see here this spike up broke the 50 line here and continued forward. So if it didn't break that 50 line, it would bounce down and create a P3. So if it were to go here, here, then that would be P3. It'll be the same exact shape that we talked about up here. Right here. So what we saw was P1, pulled back, P2, blasted up, didn't get stopped, so it kept going. So what happens if it keeps going? What happens when it hits P2 and it keeps going, right? What happens here? When it breaks the peak is gone. That means we have re-entered P1. Same thing with right here. If it were to break down and it breaks this peak, then it's just P1, P2 still. It goes back up, it'll form a new peak. There's still P1. It's just basically a reset. But we don't need to get into that moment. So whenever a peak is broken, it just resets that to the previous peak because it continued the trend. So if it were to break up here, that's the same as just a P1 all the way up. It would have to pull back again to a new 50. Okay. So if this right here were to break, P1 again. Same exact thing. So P1, you'd have to enter. If you're not in the P1, then you should not enter until P2 forms. So we use this here as an example. Right here, we'll let it play out. So that becomes P1 again, right? P1. What you can do right here on that breakout is you can enter, okay? You can always exit here, but we'll talk about breakouts afterwards. But this assumes P1. Let's just keep going, see if it ever hits P2. You just pull this with it. That's all you have to do. And again, if you're not in a P1, you just got to leave it until it hits 50%. Okay, and you keep dragging it. Technically, there is no breakout in a P1 because it is in a breakout. And if there is a volume change, if sometimes you see a really big candle that goes like this, it's not really a breakout. What happens is it's inflated. It's just inflated itself. So if there's sideways movement here like this, and you see a really big candle up like that, it's fairly likely going to go like that. It's just an inflation version of itself. So let's keep playing. Let's see here. It's likely not going to hit that 50% line. This is very close. But because it didn't hit the 50, I don't expect it to blast off. It can trend its way up slowly, but I don't expect it to blast. And if it does, it's a self-inflation. And so it's going to pull itself back anyways. There's a trend up. So it's a very small trend up, and then it comes back down. So we can see just like that. So now because it kept pushing itself up in the trend, it has to come, it changes the 50% line. So we have to keep moving it. And very likely here, the day is going to end soon before any kind of breakout. So that's just sideways consolidations there. We could technically even just move this all the way up if you wanted to play this. You could even move it up into a smaller time frame if you wanted to play there too. So basically each candle is going to have its own. You can have a P1, you can have a P, you can have a downward P1 inside of an upward P1. But overall, we can just keep with just the one here. And as the day goes on, it just elongates the P1 play. That's why it gets more difficult. A lot of people like to play the open because that's the most volatile. That's before any kind of the expansion of P1 happens. Because once P1 expands, you can't really enter until it pulls back. Let's go talk about entry. So we have entry. So how do you determine your entry? So here, let's say we start back over again. we pull this here, did a 50% pullback. This is where we would enter. Let me see if I can pull that back further. Right there, we would enter there, hit a buy. We know that this is P1, right? In upwards direction. So where our bias is long, where would we stop out? You can stop out at the 60% line right here, or anywhere between 60 to 75. Don't go past 75. It's all up to you where you want to pick this, because at opening, the volume changes, right? So it could spike very large. So you can do that. Take profit. Where do you want to take profit? I take profit at the peak. So I don't want to risk it. As in, it comes up to the peak, it could challenge the peak and test it, and it could fail. I'd rather just exit, take the profit, wait for the penetration, and then enter again. So let's do that. If it does that, I would not enter again. I would just wait. That is not a confirmed breakout. So I'll wait for it to break. It's gonna break. I want to wait for a confirming candle. Nope, it's not confirming. Break, and then this is confirming. So here is where I would enter. And I would put a stop loss back down here. And if it comes back down and rejects, I'll be fine with taking that. It's basically a free trade here. And then you're in a P1. So how do you determine? So P1 is difficult to enter, right? Until you go back. So how do you determine where to take your profit in a P1? You can take your profit anywhere in a P1. It's all up to you where you want to take the profit. But once you take your profit, you can't enter again. Okay, you can't enter unless it pulls back to 50. So it's all up to you how you can just pull this up and do a break even play and let it keep running. You can do that, or you just take a profit and exit. You know, in your first red, or even what I usually wait for is an overtaking red. So overtaking red, I'll see if I can see it here. Like this. So the red overtook that previous candle, as in it broke lower and closed lower than that candle. Is when I would just take my exit. So I'd walk away. Basically, I'd be done if it doesn't hit the 50% line. I'd know when it's done if it gets really close. I believe we got really close here. Like right there, and it didn't tap it. Where's our 50? Yep, that's 40. That's our 50. Because it didn't tap it and its bounce is not that great and it doesn't come back down again. Let's see. It doesn't come back down. By this point, I'd probably just stop playing. It's just consolidation. And I'd come back and check. Because even if it taps the green, let's say it taps, like sometime I check back and it taps down here and it's already back up here, that would still be a good play to enter. You don't have to catch it exactly here. Because once it taps, you know that it can keep going up. So this would be pretty quick morning. Take the $180, and this is just in micros. Just take the one, and we only paid twice, right? One, yeah, only played 2 times, and we made almost $200. That's a very good goal for a day. $100 to $200 a day is really good. And that's our entry. Third is our risk management. And again, it's our most important. You need to know how much you want to risk, and not just in per trade, but say per day total. So let's say I enter a 1-to-1 ratio here. I'm gonna go back. Yep. Let's say I'm just gonna play pure risk management without drawing any lines or anything like that, and I'm just gonna enter a 1-to-1 ratio at say $100 each. So I just pull 100 and 100. And I could just keep risking the 100. And I wouldn't care where it goes. It doesn't matter where I enter. I can sell now and go 100. Oops. It cuts me out. Now you can choose for yourself. Your risk management is you're going to cut and stop playing on your first loss. You can choose that. That's your risk management. How much do you want to give up? So you need to have a plan for your risk. What is your target profit? How much are you willing to risk in a day? That would determine your entry, right? Because if you enter and you're risking more than what you want to risk in a day, which is more than 100, then you wouldn't take it. It wouldn't be a play that you want to take. You should have a risk management strategy where you should be profitable, right? That's when people take trades of different ratios. They take trades of, say, like a 1 to 5 ratio, and they can lose 4 times, and they should win the fifth to break even. And so they would only look for trades that would give, but I would only have that loss right there. So they do that. And if they win, then they'll be done for the day. If they lose, then they should also be done for the day, like that. So you have to pick a risk management strategy, and you have to stick to it. And that's the most important. You got to do that first before you do anything else. Without the risk management strategy, you can end up revenge trading. So you lose, and then you enter more and more and more and more, and you just blow up your accounts. So you don't want to do that. Just pick your days. Usually you would win, say 2 days, you lose 2 days, win 2 days, and then the last day is your day. You should be on your day of profit. So 60% win rate. So a 60% win rate should be 2 losing days, 3 winning days. So don't be afraid to lose or to end your day on red, right? If we ended at 47 here, that should be pretty good. We call it quits. Don't keep chasing it. Don't try to get back to even. It just doesn't look like a good day. We'll just stop, even if it's at 10 o'clock. Right? Just wait until, if this is the P1, and if you're chasing a P1, you're likely going to lose. If you enter P1, we can plan an enter here on P1, and your plan would be, if it hits 50%, you'd average down. If it hits 60%, you'd exit, right? And so we could do that. And if it taps here, we'll enter a second one, we'll average down. If it hits here, we'll exit. And so our loss would be, that's your $200 loss. So you'd only enter that if your risk management allows you to do that. Otherwise, you would not take that trade. Because even if we were to break down here, you're probably losing like 250. So know your risk before you play. P1 should be pretty simple. Let's run over a few more random days here and see if we can get identify some of the dates or some of the peaks. Let's do 14. And then we'll pick, let's see, where's 8:30? Here it is. Okay, so I like to start the peaks new at different volume changes. And I usually just like to do the 8:30 when it opens, and then it runs into like 9:30. So you get initial balance your first hour, and then draw your peaks. So this continued here. This was a P1. Watch, I can show you. This is P1, and it was up and it pulled back, but it never broke. So we're at P1. Never really even got to P3. Got to a P2, but it just kept getting pushed further down and further down. So that was a P1 upward momentum, but because it broke It broke this P1. It became, this is now P1 in the downward direction. So let's draw our ladder. Still not pulled up to 50 yet. So this is P1. We wouldn't be chasing it. We wouldn't enter. We would enter if it taps here. If it breaks above and exits us out, then it's likely it could reverse. So that's why we want to exit. We don't want to keep holding it until it breaks this top. So let's see how it goes and see if we can exit or we can enter it at that bounce. And sometimes it won't let us enter. There's a tap, we'll enter, stop loss. Oh, it's supposed to be a short. My bad. 1 second. There you go. So that's our risk. Pretty small risk. Almost 1 to 5 ratio here. And let's see if it allows us to, or it's going to cut us out. Pretty close there. Cut us out. That was pretty close. So that's how we know. So we exit out. We don't want to test that. We don't want to pull back any further. We could have also pulled our stop loss down to break even. That's what we wanted to do. That usually you get exit out quite often if you do that, but it makes your trade free. If it breaks up here, we're pretty confident this could be a reversal now because it broke above that 60 line. These are pretty strong movements here. We can even enter along. Stop losses back down to 50. We can do that, and then it's going to test the peak, right? We always want to exit at the peak and let it test. So we can let that play out. There it is. So we won that. Let's see if we can pull this. So what happens there? It broke that P1, right? So that P1 is gone. So let's remove that. Let's redraw everything here. We draw a ladder, low points here, our current high is here. This is now P1 in the upwards direction. So it broke this peak, so we have a chance to enter P1 because it just established P1. So we can set one here, stop loss. Again, you can pick whatever your risk management is. You can pick here. It's a pretty strong line because it bounced here and bounced up again, risking 100. Where's the target? Again, there is no target. I mean, you can go all the way back and look for the previous P1 if you want to, but we're not going to do that. It's too complicated. We're just going to go until an overtaken candle, or we can just move up our stop loss. There it is. Broke us out. Basically, it's just an expansion and not a breakout. Why not a breakout? It didn't really pull down to 50% to get that big of a momentum. It just kind of trended its way up. But it's worth playing because even though breakouts can be fake, if enough people believe in them, they could come true. That's why we just pick our exits line. Basically, today's play is essentially over here. It's 2 o'clock. Even if we hit our 50% line here, I don't know if we have enough volume by the end of the day to really blast up and challenge that peak. So let's say that we can enter. It's just not too wise to enter because I would probably target the 50% line here. I don't know if we have enough volume to challenge that peak up top. And by 50% line, I mean we pick that top down to this peak. The line right here. Let me pull that. Yeah, look how close that was. There it is. So we made it to the 50% line. $40. Let's see, we're almost at the end of the day. Let's see if we can make it to that peak there. Yeah. Weren't able to make it. Pretty easy to see. We're basically at the end of the day. It was likely that it wasn't gonna make it up there. So we can clear all those. 40 days or $40 there on the day. Pretty good. 3 trades. 1, 2, 3, 4 trades. It's 4 or 3. I don't remember. You can pick another day. Let's see here. You can choose 25th. 8:30. Let me check 1 second. All right. Again, you don't have to chart this. You can if you'd like to, but I usually just like to. With this peak strategy, you can really just zoom in to any time frame and play it on its own. You can even play it within time frame itself. So I'm gonna let it play for. Oh, where are we? This is the wrong time. I gotta pick another date. Let's just do another bar here. I gotta pick at 9 o'clock. Or did I just choose too far of a date? Data points unavailable. Oh, let me cancel that replay. Let me pick a new date here. Let's do the 28th. It's not working. Second. Please pick a time. The 30th. Let's do that. There we go. All right, let's play our initial balance. Initial balance is just our first hour, just the range. So pretty nice there. We got basically, what do we get? We get just straight down P1, and we bounce up. We got a P2, and we broke the P1. So because we broke P1, this is now P1. Words, so we're moving up. So we'll just draw our ladder here. So here you can enter in this breakout, all up to you, and then you can average down again, or you can just wait until it pulls back. If it doesn't pull back, then you're just out for the day. That's all it is. We don't want to enter losing trades. Waiting for the tap. Okay, tap there. Enter, stop loss there. Our target, probably one candle from the top. Here you can decide if you want to take it because it's close enough, right? I think I'll just take that. So that's, you can even end your day here. It's pretty nice. Now we're just consolidating. It needs to break. It needs to tap 50 again to get momentum, or it's going to break this 50 line in reverse down, or it has to challenge this P2. So we have P2 up here. Basically like that. Here's P3 formed. And then we have consolidation. P3 forms, we're going to go like this. It has to go like that. So because it's what it's doing is it's creating liquidity. It needs to sweep liquidity to bounce. So we're just going to pull this through here. Just so we can see it. Or you can just make a 50% line if you'd like to. Be a lot easier to see. There's the 50. You can buy. Pretty cheap trade here. Um, I can take a 50% exit. Basically, 50% line up to 25% line is the 50 exit. Probably go a little bit lower because it dipped a little bit lower. But that's a pretty good trade. 1 to 3 ratio there. Yep, really cheap trade. You didn't have to, it's an easy risk there. Very good reversal, break of this line, and then it has to test this peak. You definitely could enter short here, and obviously exit up above this peak. But we're so close. We're one candle away from challenging the P1. We're not going to enter. We'll just let's see if it breaks it, then we'll enter. This is still P1 up, or it's still upwards. Until it breaks this, it's still upwards momentum. It's just likely because it broke down here, it's gonna trend down here until it makes a decision where to go. It's getting pretty small here. 2 o'clock. I always exit at the 2 or look for an exit and don't want to enter again. Very easy to see that this should be a bounce because momentum is it just won't be there to break this peak, even if it does just not have enough time to keep going. That's basically done for the day there. So $70. That's essentially that. Do you guys have any more questions on the peaks? I think that should be enough. Pretty redundant there. Let's go over strength analysis. So how do you know when to exit a P1? You can use strength analysis to see that. It's kind of hard to share a replay on strength analysis. Basically, what I use is I use the NASDAQ and then I compare it to the ES, basically the SPY. Let me add that in here. Can you guys still hear me? You guys with me still? You guys can type in the chat. So basically, we can do a reference between the two, either NASDAQ or SPY. And whatever is stronger just means that it's going up more. And then whatever is weaker is going up less or going down. So whichever stock is weaker, that's the one you want to short. Whichever stock is stronger is the one that you'd want to go long. And you can also check when it starts consolidating, you can check where it's going to end. So we can see here, if it dips here, it's very likely this dip is going to stop. It's going to stop because it's bouncing off of a line here on the ES. So we can see that the NQ is a lot stronger, even though it dips. See, we get to the 10 o'clock here. Here's the 10. That one's going down. So you can always use a reference. This is where your divergence comes in. You can use this as your divergence. It's basically saying that it's even if it's climbing up, it's decreasing momentum. So even just like that, we can see it's not likely going to be a breakout. You want to wait until this also breaks out. Right? If that were to come up and challenge that, that would be really strong. It's like a rubber band effect, and it allows this to go even further. So let's say if this were to break up here, say this broke out here, this broke out here. Let's say that continued to go. This will go up to here and check it. That means this will go until this hits here. And that would be a really good point to exit the NQ. Because in a P1, you really don't know where to exit. Right, this is P1. It'll just keep going. So you can use a strength analysis and compare the two and determine when to exit. You don't have to use the ES nor the NASDAQ for strength analysis. You can use the RSI, you can use the MACD, you can use a tick chart. Basically, these are the ticks right here. Just it's not a time base, it's an order base system. So you can use that as your analysis as well. And they all work really well, just as a comparison. So that's strength analysis. So if you were to, let's say if we were playing options and you see that the NQ is strong, go find a stock that's in the NQ that's even stronger, as in something that's even more upwards, like Tesla. So instead of buying options or call options on the NQ, you can buy call options on Tesla instead. Because you have a better chance of it. If it were to drop, let's say the NQ were to drop on Tesla. So let's say like that is the NQ on Tesla, it'll probably go like that. So you basically reduce your risk. Divergence, we kind of covered that. And then we also covered what you can use for strength indicators. That's basically our first hour here, so we're almost there at the hour. We have about 45 minutes. You guys want to cover any replays that you want to see, or if you want to run it on your own chart, on your own screens, or any questions you might have. I'm just going to stop the recording here.